Happy Tropical Storm Monday here in Boise. Everybody's all excited about this tropical storm. It's supposed to dump, 3 inches an hour or something they were saying a couple days ago. Yeah, it turned into a slight, drizzle all night and all morning, but it's better than 3 inches an hour, thankfully. Don't usually get this much rain in August, even at the drizzle side of things, but we're grateful for it. Being from Minnesota, I love a rainy day every so often, so this is a good thing. I'm enjoying today quite a bit, to be honest with you. Had a great weekend with family. All my college kids are back in town. Had a full house. Didn't get enough sleep because we stayed up too late talking. So if I trail off and don't make sense at some point during this video, you'll know why. But moving on, we're going to focus now on rates and where we're at. So the 10-year Treasury, let's talk about that today because that's the leading indicator for mortgage rates. 10-year Treasury chart is up 9 basis points today. There is anticipation that the Federal Reserve will start, of course, they're going to start their meeting on Thursday in Jackson Hole, Wyoming. That's their annual retreat where they talk about all things interest rate and inflation related. There's concern that there's going to be more hawkish tonality coming out of that meeting, notes and minutes and interviews coming out of there that could portend and indicate the Federal Reserve is wanting to continue to raise interest rates to combat inflation, which unfortunately they probably need to do, to be honest. However, they are determined to get down to that 2.5% rate range, and they're wanting to do it fast, as you can tell over the past year with how quickly rates have gone up. So let's hope they don't continue to do it too fast and break too many more things in the economy in the meantime. That's the bigger concern, is how quickly they're doing it. So let's look at this, the 10-year. Okay, if you can see this, I'm going to draw a little line here so you can see kind of a trend we're seeing from the past, say, month or so. As you can see here, we've got a trend line. Take the tops of most of these green candles. This trend line is seeming to indicate that if this ceiling at 4.33 is broken over the next day or so, we could easily go up to 4.4 and then possibly up to the next ceiling of resistance at 4.5. Okay, that's not good. All right, if we do that, we'll see interest rates rise even more. Now, if this holds, it could bounce back and drop. There's plenty of room to drop back down and improve interest rates. I sure hope that happens. We'll be watching this closely. So what does this look like when it comes to mortgage-backed securities? Well, as you can see, the universal mortgage-backed security chart here is down 34 basis points. That's the opposite of the 10-year Treasury. The price is what we're tracking on this chart instead of the yield. So the price of the universal mortgage-backed security bond is down, and that's not good. That means that interest rates are continuing to increase. I want to show you a chart going back a full year, if I can pull this up here. But as you can see, over the past couple of weeks here, we've had a major decline in price. Not a good thing for interest rates. We've seen interest rates go up fairly significantly over the past couple of weeks, right? Another 0.5% or more. So now we're solidly into the sevens. I unfortunately had to quote an investment property interest rate over the weekend, and boy, those are in the eights now, right? With points. So it's quite expensive comparatively to 6 months ago or even a year ago to buy investment properties, and expensive, of course, on the interest rate side for primary residences relative to where we were a couple of years ago. Is it expensive overall over a 40-year time period or 50-year time period? No. 7% interest rates are actually pretty average, so that's not necessarily super high, but it sure feels like it when we just came off of 2 and 3%, a year and a half ago. So let's take a look at this. If you can see, going back to October 21st and October 13th of last fall, that's the last time we've been in this range for the mortgage-backed security price. Unfortunately, that was the peak of the interest rates, or a really high point in interest rates for 2022, and we're kind of back to that level now, solidly in the sevens on 30-year fixed mortgages. Depending on credit score, of course, down payment and program, it'll range, but somewhere in the sevens is basically where we're at this point. Let's hope that this floor here holds. I'll try to zoom this back in so you can see it a little bit better, but we're at a floor of support here right now that today was breached but came back. So if we can close above this, that would be a good sign. That may mean that we'll have an opportunity for the price to bounce back and have an improvement in rate. But if it does not hold over the next couple of days, there's a lot of room to drop on the price and have interest rates increase even more. So I'm sorry I'm the bearer of bad news today, or not great news, but it's kind of iffy at the moment. But if your clients are considering locking and want to know what to do, I'd probably wait till tomorrow morning, take a peek and see what happened here with these levels of support on the MBS, UMBS, and also on the 10-year Treasury. But if those have been breached, that ceiling on the 10-year and this floor of support on the UMBS, I'd go ahead and lock in because it's likely to get worse before it gets better over the next week or two. So that's my advice for today. Hope you have a great one. Feel free, of course, to reach out, call, email if you have questions. And don't forget to follow me on Instagram. Still putting together those reels. I'm still doing short reels that are hopefully interesting and somewhat entertaining, but interesting information that you're able to share with your clients to help them understand various aspects of the mortgage and home financing process.